Let's find some day trades, swing trades, and option trades. Good morning, traders. It is Thursday, July 23rd. It is about an hour and a half before the open. I thought I'd do a quick video. I'm going to do an abbreviated version of the weekly swing trading video. So if you're a member, you can skip this video. But I wanted to go over the market conditions right now, and I wanted to describe what's happening and how we're positioned for it. Before I get into everything, I wanted to put up our performance. So I'm going to slide this screen over. This is our staged order entry screen, and we can see all the trades that we currently have on. It has been an incredible run. Our last losing trade was in the middle of February. We entered a bullish put spread on Disney. We bought that back immediately because I didn't like the market conditions. We lost about 20 cents on that. That was 6 months ago. And you can see here that the green trades on the top, these were two naked put rights that we did. BILI sold the July 17 35 puts, sold the BZUN July 17 $35 puts as well. And in this case, I think we got about 85 cents. The stock had pulled back the morning after. In this case, we got about 60 cents. On average, these two trades netted about 13% return in 3 weeks. Really nice trades. Then we had Walmart. We did fantastic on Walmart. So we sold a bullish put spread below horizontal support. Lo and behold, Walmart announced that they're going to have their new club membership. Stock rallied about 10 points. Never had to worry about this trade at all. That was a 25% winner because we collected 20 cents and there was $1 between the two strike prices. So that means that we need to put up $1 minus 20 cents. We need to put up 80 cents in margin. We made 20 cents on 80 cents in margin. That's a 25% return. And that is the normal target that I look for. That's a pretty aggressive target, but because I use a lot of momentum indicators, I use heavy volume, I use relative strength, I lean on major technical support levels, all of those factors increase my probability of success, so I can be more aggressive with these spreads. As we go down the list, we can take a look at all of these trades. I'm going to skip over MOMO, Amgen, SPCE, Facebook, PayPal, TWLO, all of those 25% winners. So let's take a quick look at what those stocks have done. And we're going to go in, take a look at Amgen real quick. I love this horizontal breakout right here. We sold the 240 puts and we bought the 237.50 puts. We did that for a 50-cent credit with 2 days left. You can see how the stock is almost $17 out of the money. I don't think we're going to have any problem with that. 25% winner. SPCE. This one I highlighted in a Sunday night video. I love the support right down here, horizontal support and the 200-day moving average coming into play. We sold the $15 put, bought the $14 put for a 20-cent credit. This one expires a week from tomorrow, and you can see the stock is up at $26, more than $10 out of the money. Don't think we're going to have any issues with that one. Another 25% winner. Facebook, you can see this beautiful horizontal support level. The company had some advertisers that were leaving because of their policies, so the stock temporarily dipped down. But that spike in option implied volatility gave us an opportunity right here to sell those out of the money bullish put spreads. And we had another influence working in our favor, which was we knew from Option Stalker that this stock has a tendency to rally into earnings. It's done so more than 75% of the time over the course of the last 3 years once it gets inside of that 2-week window before option expiration. I'll take a look at that search in a few minutes, and I'll show you what a gold mine it is ahead of major earnings announcements. So, Facebook, there we are short the July 24, 225 puts. Right down in here, you can see they're $15 out of the money with 2 days of trading left. Don't think that's going to be a problem. 25% winner. PayPal. PayPal, you can see this nice long tail under body, nice horizontal breakout right in here. So we have 1, 2, 3, 4, 5 levels of support. On PayPal, we're short the 165 puts, long the 162.50s. We did that for a 50-cent credit. And you can see that at the 150, 165 strike, we are again about $15 out of the money with 2 days left. I don't think we're going to have any issue with that. 25% winner. PayPal also has a tendency to rally into earnings announcements. TWLO. TWLO, we've got 1, 2, 3 really beautiful support levels here, right on that major breakout. And I liked that breakout. That was resistance. Now it's support. 1, 2, 3, 4. Almost gets down to it, but finds support actually above this level. We were short the 205 puts that expire tomorrow, July 24th, and we're long the 202.50 puts. Now this one we did not do for a 50-cent credit. This one we did for a 40-cent credit. It's still going to yield a 20% profit. So really nice trade. And in this case, at 205, the stock is up at $270. Not going to be a problem. So the final trade was Starbucks. And Starbucks, you can see right here, I put this video out for everyone to the public. This was on Sunday night. We're going to try and sell the $71 puts right down on that nice, beautiful horizontal support level. 1, 2, 3, 4, 5, and below the 100-day moving average. We were trying to sell these. Expiration is tomorrow. We needed to get filled on Monday. We were trying to sell the $71 puts by the $70 puts for a 15-cent credit. That would have yielded us somewhere around an 18% return in a week. Didn't get filled on that trade. So if we take a quick look at the trades that we did, about a 13% winner on average between these two in 3 weeks, 25% winner. I'm going to count these to be winners because we're so far out of the money. Amgen, 25% winner. SPCE, 25% winner. Facebook, 25% winner. PayPal, 25% winner. TWLO, 20% winner. Starbucks, we weren't able to get in. You can see that after this week, the only trade that we're going to have on is the SPCE July 31 put. And that, again, is more than $10 out of the money on a $26 stock. It'd have to fall almost 50%. Not going to be a problem for us. So we do have one lingering trade here that I'm going to be talking about. And I also want to mention Facebook, PayPal, TWLO. We put these trades on a week ago. So in a week and 2 days, these trades are going to each generate almost a 25% return. TWLO, not quite there. But we did run into problems with MOMO. And right now, we have tensions between the U.S. and China, and that is weighing on the stock. China has strengthened their grip on Hong Kong. The U.S. has removed favorable trade status for Hong Kong. So that is weighing on all Chinese shares. We were expecting the support level right in here to hold and the open from that long green candle to open. Well, it came down and tested that support. Everything was fine. In fact, on Tuesday, we had the stock at $19.50. So we only needed a few more days for it to flatline down on the support, and we would have been fine on it. As it stands, we're going to be buying back the MOMO July 24th, $19 puts, and we're going to be selling the $18 puts, and we're going to be doing that for a 40-cent debit. That will be our order today that we have out there. If we lose on this trade, we're going to lose about 25% based on the margin that we put up. If we don't get filled today, we're going to have to try and buy it back tomorrow. There is still a chance the stock could pop and go back above that $19 level. So we could actually have another winner. But the point that I want to make is, let's say, for sake of argument, that MOMO falls and it goes down below $18. Well, it's fairly rare, but in some instances, you're going to take the full loss on a bullish put spread if something dramatic happens overnight and you're not able to adjust the position, and if you get close to expiration. Well, in this instance, we've got a 100% potential loss on the trade. Well, that means that we've just wiped out 4 really nice bullish put spreads that have generated a 25% return. So it doesn't take much. You've got to be so selective and so careful, and that's exactly what we work on as we try and get all the check boxes marked so that our probability of success is extremely high. That's how we've been able to make money hand over fist. I know you're making money hand over fist because I hear it from you. Everyone's writing into me. They're telling me the money that they've made. Makes me feel great that everyone's on board. But please, you have got to understand the strategy, because having one losing trade, some of you don't even know how to buy the spread back. And that scares the daylights out of me. You've been able to put spreads on. They expire worthless. No action required. But you don't know what to do when we run into trouble. So this Momo trade is a warning sign, in my opinion. It's a warning sign that we all need to brush up on how to buy these spreads back. We need to do a little homework on assignment risk and what it is and when it comes into play. So I'm going to try and do a video in that respect. And also, after 6 months of incredible performance, my biggest losses have always come after my biggest gains, and this is after 30 years of experience. So when you start pressing, eventually things are going to sour on you and you're going to give a lot of money back. So I don't want that to happen. And we are going to let these positions expire. I'm not going to have any new swing trades this week. We're going to try and get to a cash position. You know that's what I've been trying to do because I've been putting it in my market comments for the last 2 weeks. I want to go to cash. I feel that we've got one more really good push higher in the market, but once mega cap tech stocks have announced earnings, I feel the air gets let out of the balloon. The back half of earnings season is not going to be nearly as strong. You've got retailers reporting, you have energy sector reporting. So it's going to be very, very soft in the back half. Also, right now we have a $1 trillion stimulus package that's going to be needed. Republicans and Democrats are hashing that out. It was going to be a slam dunk done before July 31st. Now, not so sure. Just the fighting between the two parties is not good, especially when that stimulus money is needed. And DC is going to go into recess. And when DC goes into recess, and that includes the Fed, investors get very, very nervous, especially as the coronavirus continues to spread and grow. So we need to be very, very cautious in here. I'm going to remove this screen, and we're going to take a look at what the market's doing. So MOMO, we're going to be trying to buy that spread back for 40 cents today. If we're not filled, I'll send instructions tonight. And let's put up the SPY, take a look at what it's doing. So you can see here that the SPY, S&P 500 depository receipts, have been able to grind higher in a pretty nice fashion. We had a nice little compression here and then moving higher again. These tiny little bars in here, these dojis and these very compressed candles, tell me that there is resistance building. When you have nice big long green candles closing on their high, then you know that the market still has some momentum in it. But the other thing that I want to point out is the minuscule volume that we're seeing right in here. You see how the volume is continuing to decrease and decrease from these levels? That is not a good sign. That tells me that the level of conviction on the upside is fairly low and that the market is vulnerable to profit taking. So you have an economic recovery that was supposed to be V-shaped, and we were supposed to shut down for a month, month and a half, and then we're going to flood the market with money, and we're going to be able to get right back on track. That's not happening. Here we are 2 months later, and we're still having lots of states that are in phase 3. Some big cities are even looking to go back to a complete shutdown. So this is going to prolong the economic recovery. I do see some credit issues that are probably going to surface. Airlines are probably going to need bailout money. You've got energy companies who are starting to miss bond payments. These are primarily the drillers and oil producers. You've got 23 million people who are going to be potentially evicted from their apartments in October. You've got 12 million people who missed their rent payments back in May. So people are living hand to mouth, and they very much need this stimulus check. If their jobs aren't coming back because of a sluggish economy, they're not going to be spending money because they're going to be wondering how secure their jobs are, especially when the PPP runs out. Now, I know that one proposal that the Republicans have right now is that there would be a $100 additional weekly check, a supplement to unemployment benefits. That will be down from the $600 that's being currently paid. So again, the money is just going to start drying up because we've got $6 trillion in stimulus that's been spent. Now they're adding 1 trillion. Maybe it's 1.5 trillion, but there's not another 2 trillion, 3 trillion, 4 trillion coming after this. The money has been spent and they went all out right from the beginning to get the economy kick-started. So I think that seasonality comes into play as well. You start getting people that are a little bit nervous heading into the middle of August when DC is shut down, and profit taking is likely. We just had earnings from Microsoft, and that brings up another topic, which is that the market rally has been narrowly defined. That means that tech stocks have rallied, but they comprise a relatively small percentage of the S&P 500 in terms of the number of companies. So if you look at Microsoft, Amazon, Apple, Google, Facebook, those companies represent about 20% of the S&P 500 market cap, and you have this disparity. You've got lots and lots of companies that have many, many employees. Again, the travel and entertainment industry. You look at restaurants, you look at airlines, you look at hotels, you look at the energy sector, you look at retail. We're talking about many, many, many jobs. That's going to start weighing on the economy because all of these workers are not going to be out there spending money. When you have such a narrowly based market rally, a lot of these stocks, I think, are getting very stretched in terms of their valuation. Last night, Microsoft posted a great number, 13% revenue growth. Stock is down about 3% on the news. Good news is priced in, and I think that Microsoft is trading at a current PE of 35. That's rich. That's lofty. So you've got a small portion of these mega cap tech companies that have rallied, and they have rallied hard. And I think that they're getting overvalued, but you've got all of these other companies who are lagging, and the business conditions are not improving like all of us had hoped. So we've had a huge run in terms of our profitability, in terms of our trading success. We have a lower volume coming into play. We have seasonality coming into play with volumes dropping off, traders taking time off before school starts, DC and recess. That's going to weigh on the market. And you've got a very persistent coronavirus with lots of states retreating back to phase three. Already, the number of states that are in phase three account for about 40% of U.S. domestic GDP. So we're talking about significant numbers here. So, what do we do in this situation? Pete, you sound a little bit bearish. I am bearish. I think we're going to get a market pullback. I don't know that it's going to be a monster market pullback. We will only know that if credit conditions do worsen, which, by the way, if you look at the major banks, they've all had to take significant write-downs recently. So that is also not a good sign. I haven't even talked about the financial sector. Financial sector, a lot of the banks have reported in a zero interest rate environment, they're going to have a very tough time making money. You've got a lot more bad loan write-downs, and you have potentially a lot of people not spending money because they're unemployed or they're questioning their employment. So I think the financial sector is also going to struggle, and we've seen that in the earnings reports and in the reactions. So that's another sector that has been lagging. So, what do we do with this information? Do we start buying some puts? No, you do not buy puts until you have a technical breakdown. And you need that confirmation, because otherwise you start buying puts in here, and lo and behold, the stimulus plan goes through and everything looks great and the market continues to float higher. Your puts go down in value dramatically. Same reason that you don't want to sell out of the money bearish call spreads, because the momentum and the market currently point higher. So what you have to wait for is you've got to wait for a crackdown and some long red candles closing on their low, follow through, another long red candle closing on its low. This upward sloping trend line that comes into play right around, let's call it 316, I think would be your first line in the sand. If you're looking to get short and you had those long red candles, which by the way, this can happen in a day. This can happen in 2 days very, very easily. We've seen one day 100 point, 150 point S&P moves this year. So this is not unusual. One of those moves will strip away weeks and weeks worth of market gains, and that's when you could see bullish speculators getting flushed out of the market. That selling accentuates that move lower. You could have natural profit taking from asset managers who want to reduce risk. So it could happen quickly, but we need to have those signs, nice big long red candles breaking through technical support before we can start thinking about shorting the market. And even when the market does come in this fall, again, I need to have some clarity. I need to see how bad the credit conditions are getting. But my suspicion is that we get this retracement, the coronavirus starts to settle down again, and towards the middle of fall, maybe in late October or so, we start to have a nice, decent rally, and then we recover into year end. And who knows, perhaps even take out this 326 level. So we've had such a great run. We've got a quiet market right now. Once earnings season ends in a couple of weeks and we get the jobs data, I feel that we're going into a news vacuum, and the trading volume is going to be very, very light. The risk is going to be elevated. The upside rewards are going to be smaller than the downside risks. We are going to cash. We're going to be on the sidelines. This is something that most traders cannot do. They absolutely have to have a trade on all the time. And I think it's one of the big mistakes that traders make is they don't know when to sit on the sidelines and when to wait for clarity and when to wait for the probability to be more favorable. Well, we're going to do that. And when these big hurts come and you get these big sell-offs, and I don't know what could cause it. Maybe it's U.S.-China relations. Maybe it's something with the coronavirus. Maybe it's something with credit. But whatever it is that causes those big drops, once that happens, the option bid-ask spreads widen dramatically. You could drive a truck through these bid-ask spreads, and you have $1.50, $2 bid-ask spreads between the options. And if you've got a spread on, now you've got two legs that you have to navigate. You have no idea where you might be able to buy that spread back. And quite honestly, when the market's in free fall and you're trying to buy back a put spread, nobody is really willing to sell it to you because they don't want to be on that side of the trade. So very, very difficult to reel those trades in. I know everybody thinks, well, I'm nimble, I'm quick, I'll be able to buy those back, no problem. It's not going to work that way. And we already saw that back here earlier in the year when you could not buy back your spreads. So, best thing for us to do is to be in cash. And instead of managing losing positions when you start to milk the last drop out of this market rally and you get that first crack, instead of managing those losses, what we're going to do is we're going to have a very clear perspective. We're going to sit back, we're going to watch the storm roll in, and then we're going to look for opportunity. Once those bullish speculators are flushed out, if everything looks good, then we'll come in, we'll scoop the market. As the pullback happens, we're going to evaluate the news. If there's some credit, if there are credit issues that seem to be part of the reason for the sell-off, then we need to be more passive and we need to really wait for that support. Eventually, when the support is established, then we can go back in, we can start selling out of the money bullish put spreads. We can take advantage of higher option implied volatilities. We can distance ourselves from the action. The stocks will have pulled back, and this is another example of what happens when you have the market rallying like this and you have stocks rallying. You lose nice visible points of support because now you've distanced yourself from these major moving averages. Oftentimes you've distanced yourself from nice horizontal support levels that you can lean on. Let me think of a stock that might have run high, maybe Adobe. I mean, there are many stocks. Actually, this one's not too bad because you've got a horizontal support level. But when you've got stocks that have run way up, maybe Apple. So Apple, you've got this really nice trend line that you can lean on, but below that, look how far you are from those major moving averages. So it's more difficult for you to sell out of the money bullish put spreads because you're so far away from these technical support levels. So this is another sign to be cautious. But let's say the market pulls back, you get 1, 2 drops, and now you're down here, let's say at the 340 level. Well, you can start considering selling some out of the money bullish put spreads even down to the 320 level, which is right around that 100-day moving average. So you want those prices to come in because now all of a sudden you've got visible technical support levels that you can lean on. You've got higher option implied volatilities, so you can go out of the money, you can reestablish those bullish put spreads, and then you can start the whole cycle all over again. That's where we're at right now, and that is the game plan. So I'm going to conclude very quickly by showing you the buy into earnings search. Again, these calculations have all been performed over the course of the last 3 years. We know that 75% of the time, these stocks rally when they're inside of that 2-week window before the earnings announcement date. And these companies all announce before the next 2 weeks. So very, very easy list. All you have to do is go through, click through the candidates, and start looking for stocks that have not gone super, super high already, where you can go out of the money and sell these spreads. Knock through that list, and even sleepers like General Motors. Now, I'm not advocating this particular trade because you can see that it did already pop up a little bit. It announces next week on July 29th. Hover over the E. But this stock has already made a nice little move higher, so maybe that is the move. I'd prefer to see something like Starbucks, and that's why I was trying to get that trade done earlier this week. This is what I want to see, and the stock was right down here, had not moved into earnings, and it was right on that 100-day moving average, plus it had nice horizontal support right here. That's why selling that bullish put spread was so attractive. Incidentally, if you would have just bought the stock and you weren't able to get the spread done, that stock was probably, let's take a look, that stock was down to $73 approximately, and now it is up to 76, actually almost 77.50. So it's gone up about $4 in the last few days. That's a really nice return. And much of this has to do with earnings. I'm going to hover over the E. You can see that earnings will be released on 7/28. This is a super, super powerful search. There are many reasons to become an Option Stalker member. This is one of them. Gosh, I got to show you this feature as well. For those of you who like to trade earnings announcements, full disclosure, I do not hold over earnings announcements, ever. I've tried to trade it for 20 years. I've tried every strategy, buying, selling, everything. It's not worth my time. It's just not worth my time. And I find that at best, you're in a 50-50 proposition. But I know some of you do like to trade earnings, so you can see this list. It's called pre-earnings options. It will show me companies that are going to be reporting after the close today or before the open tomorrow. So this is my last opportunity to take a position in these stocks before the earnings announcement. And you can see, excuse me, Intel at the top of the list. The expected move is about 8%. The average move is about 5%. And the percentage of times exceeded is 31%. So about a third of the time, Intel will exceed the expected range. So if you like to buy straddles, if you like to sell straddles, this is a fantastic tool to use. You can also see what the group performance is, the stocks that have already reported within that group and how they've fared the day after earnings and what the average percentage return has been. This may help you identify tangent plays. You can see the open interest for the puts and the calls, the implied volatility at the money for those options, and the option liquidity rating. So obviously, if you're trading options, you want to have a liquidity rating of at least 0 or higher. Then you've got an easy chance of getting in and out of the trade. So another great resource. That's it for this week's weekly swing trading video. Cash is a position. That's what we're going to do. We're going to go to cash. We've had just an unbelievable run, culminated with all of these winners. So they're going to be coming off on Friday with the exception of Momo. We'll see how we can get out of that. Hopefully we'll be able to buy that back for a 25% loss. So we'll give up one of these winners, but beautiful winners. 1, 2, 3, 4, 5, 6, 7, 8 winners. One loser just in the last few weeks, not to mention everything that we've done since the middle of February. It's time to take a break. Try and take some time off. The next few weeks are going to be very, very slow. Traders typically take time off in August. It's a really good time to clear your head, get yourself ready for what will be a very, very busy fall session. If you like this content, please give it a thumbs up. Make sure to sign up for the YouTube channel and turn on your notifications. Thank you, everybody. I will try and do a video this weekend on the common mistakes that traders make, so watch for that. Good luck trading. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.